Hi and welcome to Swissco's Daily Market Talk. It's Thursday, June 19th. The Fed decision was slightly more hawkish than expected as Fed members raised their inflation forecast and lowered their growth expectations. Now, risk appetite is limited today due to rising worries that the US could eventually get involved in the Middle East war as soon as this weekend. Other than that, investors are watching the Bank of England and Swiss National Bank decisions today in Europe. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. Someone has to pay, said the Fed Chair Jerome Powell at yesterday's post-FOMC decision presser after the Fed decided to keep its interest rates unchanged as widely expected and widely priced in by the global financial markets. Everyone that I know is forecasting a meaningful increase in inflation in the coming months from tariffs because someone has to pay for these tariffs, Powell said. As such, the Federal Reserve raised its inflation forecast to 3.1% for the end of this year, up from 2.8% that it had forecasted back in March, and lowered its growth forecast to 1.4% for this year, and that's down from 1.7% penciled in earlier. The dot plot continues to show two more interest rate cuts from the Fed this year, but that's the median forecast and does not tell the full picture and not tell the whole story because there is now a growing divide among the Fed members about where the interest rate should go in the US. While 8 of them think that they should go lower by 50 basis points, that would match 2 rate cuts, 7 see the rates unchanged this year. So that's up from 4 in the previous meeting. 2 members penciled in just 1 rate cut from the Fed this year. So that's almost a 50-50 divide at the heart of the FOMC between a no rate cut and a 50 basis point cut this year. Now, let's come to the market reaction. The market's reaction was not cheery, obviously. The S&P 500 fell after the FOMC decision, but the US 2-year yield eased, while the activity on Fed funds futures print is slightly higher. Yes, higher probability for a September rate cut from the Fed now than it did before the latest FOMC decision. It somehow feels like investors mostly wanted to see the glass half full with 2 rate cuts from the Fed than half empty with no rate cut at all this year. So the US dollar was doji at yesterday's trading session, but is stronger this morning, perhaps supported by a relatively cautious and somehow hawkish Federal Reserve statement yesterday, and also some flight to safety as there are now rumors on the wire that the United States could eventually get involved in the Middle East tensions and the war between Israel and Iran as soon as this weekend. Therefore, we could see increased inflows into the US dollar before a critical weekend in terms of geopolitical tensions, regardless of what the Fed should do with its rate policy and regardless of what investors think the Fed should do. So there is also little reason to flock into the risk markets when tensions are so incredibly high. If things get in the Middle East, there is no better place to be than oil, gold, the US dollar, and also the Swiss franc. Now, one fun fact before we move on to the BOE and SMB decisions. As you know, Powell's term will end next May, and he will most probably be replaced by someone who will have the same ambition for lowering the interest rates in the US than Donald Trump. So traders are selling March 2026 secured overnight financing rate contracts right now, and they buy the June contracts in preparation for that. But the thing is, if Jerome Powell's successor just goes ahead and cut the interest rates when there is no reason and no need to do so, other than pleasing Mr. Trump and pleasing risk markets, obviously, the impact on the yields would not be straightforward. Because remember, when Jerome Powell decided to trim the interest rates in the US by 50 basis points when it was totally unnecessary back in September last year, remember that day? Well, the US yields rebounded following that decision. So yes, interest rate cuts are good for risk assets, only and if only the market believes that cutting the interest rates is the right decision. Anyway, both the US and European futures are down this morning at the time I'm talking here, except for the FTSE futures that point slightly higher at the open on the back of softer sterling this morning, and probably also an increased appetite for energy and defense industries as the geopolitical picture darkens. Now today, the Bank of England will probably announce no change to its own interest rate policy. But the debate will probably be heated at the heart of the MPC and also outside the walls of the Bank of England, because while yesterday's inflation data showed a slower decrease in British inflation figures last month, while the dovish chorus remains loud in the UK, still worried about the ONS accuracy of the data and a budget that might be doing more harm than help to the UK economy. So the expectation right now is that the Bank of England will probably bypass this month and not announce any change, but will be announcing a rate cut as early as in its August meeting. Cable is down and testing its 50-day moving average to the downside this morning on the back of a stronger US dollar across the board, but also on some scaling back of the dovish Bank of England expectations after yesterday's data hinted at a stronger than expected CPI read. Now let's see how the MPC members in the UK feel about all this and read the data. But cable's direction depends obviously more on the US dollar appetite than Britain's internal affairs and the British economy. But the recent surge of the euro pound clearly states that the market is losing confidence in the UK's growth story. So just saying. Now, elsewhere in Switzerland, the interest rates may have been pushed down to 0% by the time this episode of Market Talk gets to you, as the trade uncertainties with the United States continue to weigh and the franc remains relatively strong on the back of these high trade uncertainties around the world. Now, even though the rising geopolitical tensions of the last few days threw a floor under the dollar franc since last week as the US dollar strengthened across the board, the euro franc sits near its all-time low levels since the euro was launched. So let's see if lowering the interest rates in Switzerland could reverse a part of that franc appetite. I am not so sure, to be honest with you. Now, note that low interest rates encourage investment and growth in an economy. But excessively low interest rates, like negative rates, for example, while effective in some areas, obviously, have perverse effects on the equilibrium of the financial system. In particular, these excessively low rates might penalize commercial banks, which are obviously unable to pass on the full cost of these rates onto their customers, thereby reducing their profitability levels and their lending capacity, hence hampering economic activity and weighing on the economic growth. Also, these excessively low interest rates in the economy could eventually lead to over-indebtedness, while low yields could deter foreign investment and compromise the country's attractiveness and also the ability to attract international funds. So it's not very, very rosy at the end of the day. The SMI index was left behind its US and European peers in attracting fresh capital after the April 2nd rebound. The strong franc certainly had a say in this lack of appetite. But this being said, Switzerland still survived its increasingly stronger Swiss franc over decades, and its financial and industrial centers remain solidly anchored because they are very much specialized. So the franc owes its strength in part to this confidence in the Swiss economy, because beyond banks and chocolate, well, innovation and especially specialization attract capital to Switzerland. But obviously trade uncertainties remain toxic for sure, and they should be addressed. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.